U.S. freight market optimistic despite economic worries. As the second half of 2011 begins, issues persist surrounding the sustainability of the U.S. economic recovery. Unemployment remains high at 9.1%. The housing slump still continues. Oil prices remain high, hovering around $100 per barrel, and rising commodity prices are sparking inflation concerns. The U.S. logistics and freight market has been affected by the slow, albeit improving economy. What started out as a promising year soon hit a bumpy patch during the second quarter. The trucking industry reported a 2.3% decline in tonnage in May compared to the month before. Air freight FTKs for North American airlines declined 1.2% in May, and railroad tonnage slowed, as did port traffic. The one bright spot among the modes of transport has been intermodal services. Rail intermodal increased over 8% during the first half of 2011. Mergers and acquisition activity increased over 30% during the first half of 2011. Many companies have accumulated a pile of cash on their ledgers, and the low value of the U.S. dollar has created an opportunity to buy into the highly fragmented U.S. logistics and freight market. Among the highlights include Ryder consolidating their market share in the truck leasing market and DHL entering the U.S. LTL market. Q1 earnings were strong for most U.S. logistics and freight providers. Many reported improvements in operating costs during this period. Q2 expects to be another good quarter, although perhaps not as strong as Q1, as effects from Japan's earthquake and tsunami and rising oil prices may add additional pressure to operating cost. For the second half of the year, continued economic growth is expected. The U.S. GDP growth estimate for Q3 is 2.8% and for Q4 2.6%. However, these estimates may be high as the country is expected to reach its debt ceiling in August. Refusal to raise the debt ceiling may result in a further decline in the U.S. dollar, high interest rates, or even another slowdown. After a slight dip in May, manufacturing picked up in June. This bodes well for the logistics and freight market over the next few months. Both FedEx and Cathay Pacific have stated they expect increasing freight demand during the second half of 2011. American Trucking Association's chief economist Bob Costello is cautiously optimistic that freight volumes will improve in the second half of the year along with economic activity. Lower oil and diesel prices should lead to a slightly better economic environment in the second half of the year, he said. However, the trucking industry will struggle to maintain and attract drivers as the CSA regulation is enforced, thus potentially adding additional pressure to the capacity issue the trucking industry faces. Mergers and acquisitions activity will continue. Perhaps this will be a good opportunity for non-U.S. companies to take advantage of the economic situation and buy into the U.S. logistics and freight market. For example, Toll Holdings announced earlier in the year they are considering U.S. freight forwarding acquisitions. A potential acquisition target for many private equity companies and trade buyers is CAT Logistics. Caterpillar announced they were exploring options for their logistics subsidiary, whether it's a spin-off, sell-off, or reorganization. A decision is expected by the end of Q3. Finally, according to a recent logistics management survey, a normal peak season is expected. Others expect a more modest peak season to occur in September and October, with freight levels to be similar to that of January-February levels. Afraid of another season of tight capacity, freight forwarders reportedly are already lining up freighter capacity out of Asia for the peak season. In conclusion, as the U.S. economy continues to slowly improve, logistics and freight providers should be able to continue improvements in operating cost. Domestic demand will remain modest at best, with the export market expected to increase thanks to a low-valued dollar.